what if what if the way you've been looking at global money is just fundamentally flawed?
Right.
When we're talking about the trillions of dollars moving around the world every single day, what if your view of that is missing the biggest gear in the entire machine?
Because you see the headlines, right?
Exactly. You see the geopolitical drama. But what if the real force moving your money is, well, what if it's operating entirely beneath the surface?
Yeah, we are absolutely conditioned to react to the loudest noise in the room. A politician makes a statement, or a diplomatic crisis erupts somewhere.
And everyone panics.
Exactly. Everyone immediately looks at the trading terminal to see how the markets react. But currencies don't actually move just because someone held a press conference.
Okay.
They move because of the massive, undeniable physical flow of goods, of capital and liquidity across borders.
Welcome to our latest deep dive. We are incredibly thrilled to have you here because our mission today is to help you master the hidden mechanics of the global economy.
The real mechanics.
Specifically, we are looking at the massive structural forces driving foreign exchange markets.
Yeah.
We're going to look right past the daily news cycle of, sanctions, diplomatic tension.
All the dramatic alerts lighting up your phone.
Yeah, we're ignoring those.
We have to step back from that immediate noise if we want to understand the actual architecture of the system.
So we are going to uncover Russia's true, long-term structural role in the global financial system.
Yeah.
Because whether you are a macro analyst, an institutional trader, or just an insanely curious person, you absolutely need to understand the gears turning this global machine.
You really do.
I mean, have you ever wondered why a shift in global energy trade permanently rewires the value of the currency sitting right there in your pocket?
Well, to understand how that currency in your pocket is valued, you really have to understand what anchors it on the exact opposite side of the planet.
Right.
Market commentary generally treats Russia's foreign exchange influence as reactive. Analysts almost always frame it around short-term shocks.
Like momentary diplomatic crises.
Yeah. Or individual sanction packages.
It's always framed as this simple cause and effect based on a morning news headline.
But the deeper reality is fundamentally structural. Russia sits at the absolute center of global flows for energy, for industrial metals. Fertilizers, exactly. And agricultural commodities like wheat. This creates a huge divergence between what we call an episodic event and a structural regime.
Okay, let's break that down for the listener, because that sounds academic, but in practical terms, how do we actually separate an episodic event from a structural regime when we're looking at foreign exchange volatility?
So an episodic event is essentially a shock. It is a trader reacting to a sudden burst of uncertainty.
Which causes a brief dip or spike in a currency pair.
Right, it's fleeting. But a structural regime represents the underlying architecture of the global economy itself.
The foundation.
Yes. It is how long-term commodity cycles, continuous energy output, and these deeply entrenched trade networks permanently dictate currency values. And we're talking over years and decades here.
It makes me think of a massive weather system.
Yeah.
The daily news cycle, tracking the geopolitical drama, it feels like the media obsessively tracking a single lightning strike.
That's a great way to look at it. And if you are only watching the lightning, you're going to get completely swept away by the ocean current.
Wow.
The structural reality, the commodity flows, and the physical trade, that is the massive silent current generating the entire storm season.
And retail investors often get trapped trying to trade the lightning.
Always. They make financial decisions based on a diplomatic press release.
Meanwhile, the massive institutional architecture, the central banks, the sovereign wealth funds, they are calmly adjusting to the ocean current.
They don't care about the press release. They are tracking the shipping lanes. They are calculating the pipeline flow rates.
Now, here's where it gets interesting. Because we are moving from the illusion of the news cycle into the heavy physical reality of commodities. Energy isn't just fuel for cars or heating for homes. Energy trade actually operates as a monetary transmission channel.
And what's fascinating here is that energy trade is the very mechanism through which fiat money derives its relative value globally.
Walking through that.
Well, when you have rising oil and natural gas prices, you fundamentally strengthen the currencies of exporting nations. And at the exact same time, you weaken the currencies of importing nations.
It is a direct, measurable transfer of economic gravity.
Exactly.
So walk us through the actual mechanics of that transfer. Like, how does a physical barrel of oil sitting on a ship somewhere actually translate into a shift in currency dominance?
Let's trace the chain reaction. Imagine a sustained disruption in global energy supply.
Okay.
The price of that energy spikes on the global market. Importing nations, countries that absolutely require that baseload energy just to keep their industrial base functioning,
Right.
they now have to spend significantly more of their own currency to acquire the exact same amount of energy.
Which immediately injects stagflationary pressure into those importing countries.
Yes.
Because everything costs more to produce, but growth is slowing down.
And that energy price spike accelerates inflation across the entire importing economy. So the central banks in those importing nations are suddenly forced into a really difficult corner.
They have to hike interest rates.
They have to. They try to destroy demand and cool the inflation down, even if their domestic economy is already contracting.
Which is brutal.
It is. And these new higher interest rates fundamentally alter global capital flows. Institutional capital aggressively moves around the world to chase those new yield differentials.
Which drastically shifts currency valuations across the board.
Exactly.
So if a major energy producer alters its output, how long does it take for that to actually hit your local central bank's interest rate decision? I mean, the domino effect is staggering.
It's remarkably fast in macro terms.
A country's entire domestic economic fate, like the cost of corporate debt in a completely different hemisphere, is effectively tied to the natural resources beneath another continent.
Because Russia has such a massive share of global commodity production, structural changes in their output or even shifts in their buyer networks immediately trigger this exact transmission channel.
The physical barrels of oil dictate the domestic inflation,
which forces the hand of the central bank on interest rates.
Which ultimately dictates the relative value of the currency.
Precisely.
But the real story is how the political sphere attempts to control this massive flow of energy. Because over the last decade, we have seen a massive expansion of financial restriction.
A huge expansion.
We've seen limitations on banking access, capital market participation, and incredibly complex hurdles placed on trade financing.
And looking at this strictly through an objective analytical lens, completely divorced from the politics sanctions, act as a profound financial catalyst.
A catalyst for what?
Well, they are designed to isolate a system, right? But they inherently force that system to radically adapt.
Okay, so when these financial restrictions are initially deployed, what is the immediate mechanical effect on the targeted economy?
The immediate effect is sharp, undeniable volatility. You see a sudden, steep depreciation of the domestic currency. Capital flight accelerates.
The market just panics.
Right. The market aggressively prices in the risk of sudden financial isolation. It is the textbook definition of an episodic shock. The existing financial plumbing takes a massive, visible hit.
Yet the policies explicitly designed to isolate a financial system often act as the ultimate catalyst for creating entirely new, parallel financial systems.
That is the paradox. The long-term effect is a profound rewiring of the global financial architecture. Because when you restrict access to traditional, established banking networks and clearinghouses,
you don't actually stop the physical trade.
Exactly. The commodities are still on the ground. And the global baseload demand for those commodities remains entirely inelastic. Countries still need power. People still need to eat.
So instead of stopping trade, you just incentivize the aggressive diversification of trade relationships.
You essentially force major global players to innovate around the friction.
You see this quiet, methodical, years-long building of alternative payment systems entirely outside of traditional networks.
You see new clearing mechanisms being tested. You see new bilateral swap lines being drafted between central banks.
And the news cycle just gives you the immediate market panic, right? The red arrows flashing on the screen when a restriction is announced.
The lightning strike.
Right. But what you are talking about is the invisible, slow-motion construction of new financial plumbing that takes years to lay down.
And if we connect this to the bigger picture, that new plumbing changes the future of money itself. The dominance of traditional banking networks stems almost entirely from their network effect.
Everyone uses them because everyone else uses them.
Exactly. But when some of the world's most resource-heavy economies are forced to figure out how to clear trades without those networks, they eventually engineer a solution.
And once that new infrastructure is built,
it doesn't just disappear when geopolitical tensions cool down. It becomes a permanent, functioning alternative.
Let's zoom out for a second and look at the concept of rewiring the global ATM. Because historically, energy has almost always been settled in widely accepted international currencies.
Right, traditionally.
But because of this long-term rewiring, alternative settlement arrangements are actively being tested at scale.
We're witnessing a massive structural shift here. Bilateral trade agreements are increasingly incorporating provisions for local currency settlements.
Meaning what? Yeah.
Meaning, instead of converting everything into a traditional global reserve currency just to clear the transaction, countries are establishing frameworks to trade using their own local fiat.
Which fundamentally redirects global foreign exchange liquidity.
Yes. And this introduces the concept of liquidity clustering.
Liquidity clustering.
Yeah. In foreign exchange, liquidity represents the ease and volume of capital moving through the system. Think of it like water in pipes. For decades, global liquidity was highly centralized. It flowed primarily into one giant central reservoir, the traditional global banking network.
So if the plumbing changes and the capital stops flowing to that central reservoir, where does it actually go? Does it just evaporate?
No, it forms new, isolated reservoirs around the world. The liquidity begins to cluster around specific regional economic blocs rather than flowing freely through traditional global channels.
Wow.
However, the friction in building these new channels is massive. It's not as simple as just signing a bilateral agreement and calling it a day.
Right, because you have to balance trade deficits.
Exactly. If country A sells massive amounts of oil to country B in local currency, but country A doesn't actually buy many goods from country B.
Country A ends up holding a massive surplus of a currency they can't easily spend.
Exactly.
I imagine a world where foreign exchange isn't a single massive global ocean anymore. It's more like a series of interconnected regional lakes.
That's a perfect analogy.
If two massive economies decide they no longer need a traditional reserve currency to trade energy for manufactured goods, they just try to build a canal between their two lakes.
But the engineering required for those canals is incredibly complex. But look, while local currency settlement doesn't eliminate traditional reserve currencies overnight, it fundamentally diversifies the channels through which international trade is financed.
It fractures the system.
It fractures the global system into distinct, self-sustaining regional networks. And those networks operate with entirely different risk premiums.
Okay, let's unpack this. Because if these alternative currencies and regional blocks are rising, and the global plumbing is actively being rewired, how does a country like Russia actually manage its own domestic currency in the middle of all this structural friction?
It's intense. The authorities have to deploy heavy, blunt instruments to stabilize the ruble during periods of extreme external stress.
Like what?
We are talking about strict capital controls, mandating conversion of export earnings, and direct foreign exchange interventions by the central bank.
Now, when we talk about capital controls in this context, we aren't just talking about a slight tax on foreign transfers, are we?
Oh, no.
Yeah.
We are talking about total mandated friction.
The central bank physically traps domestic liquidity to prevent a speculative death spiral.
Yes. Which effectively turns the domestic market into a closed-loop system. It completely restricts how much capital can legally leave the jurisdiction.
Which stops the bleeding.
It prevents mass sell-offs from collapsing the currency, sure, but it also creates severe operational headaches for any corporation trying to actually manage cross-border liabilities.
And what about mandated conversions? How do they function as a stabilization tool?
Mandated conversions target the massive export revenues. Say a major energy company sells $1 billion worth of natural gas to a foreign buyer and receives foreign currency.
Right.
The government mandates the company must take a large percentage of that foreign currency and immediately convert it back into Russian rubles on the domestic market.
Ah. So this creates an artificial continuous demand for the ruble.
Exactly. It forcibly props up its value regardless of broader market sentiment.
The central bank is essentially acting like an engineer managing a highly volatile pressure valve.
That's exactly what they're doing. They have to balance exchange rate stability with internal inflation and domestic economic growth.
It's a tightrope.
If the engineer tightens the valve too much, if the capital controls are too draconian, the domestic economic engine seizes up, supply chains break down, and foreign investment just evaporates.
But if they leave the valve too loose,
the speculative pressure blows the whole system up, the currency goes into free fall, importing massive inflation.
And running parallel to this intense domestic management is a concept the financial sector calls the commodity-backed narrative.
Right.
Because modern fiat money isn't pegged to physical gold anymore. So how does a modern currency effectively act like a proxy for raw materials?
It really comes down to market perception and the sheer weight of export revenues. Modern fiat currency has value backed by the faith and credit of the issuing government. But when a country's entire economic engine is driven by raw materials, when its export revenues heavily influence its overall fiscal stability, the institutional market starts to treat that currency as if it were physically backed by those commodities.
So if the global price of oil, gas, and wheat moves up,
The perceived strength of the ruble moves up in lockstep.
the currency literally becomes a financial derivative of global resource scarcity.
The market narrative fundamentally shifts. Macro traders stop looking at the ruble just as a reflection of Russian monetary policy, and they start trading it as an indirect proxy for global commodity inflation.
Which exerts a massive gravitational pull on other nations. We are talking about energy-linked currency cycles affecting multiple countries simultaneously.
And when we analyze structural FX regimes, this is exactly what we are looking at. This isn't random market noise. These are long-term, highly predictable correlations based on the physical, undeniable flow of trade.
This creates regional FX alignment. But how does a sovereign nation find its currency suddenly moving in perfect sync with Russia's, even if their own domestic monetary policies are totally different?
It is entirely dictated by shared commodity flow exposure.
Okay.
If a country trades heavily with Russia or critically relies on their raw materials to power its own manufacturing sector, its economic health becomes inextricably linked to that specific commodity output.
The currencies begin to move in tight historical correlation.
Right.
It feels like planetary gravity. A massive resource exporter is essentially an economic gas giant. And these smaller trading partners, their economies just become caught in its orbit.
They do. The smaller economies are locked into an economic orbit dictated by their neighbors' resource output. And this gravitational pull becomes utterly impossible to ignore during a commodity supercycle.
Now, for the listener who is maybe managing their own portfolio, a commodity supercycle sounds like a major structural regime. What actually defines it?
A commodity supercycle is an extended period, often lasting a decade or more, where the prices of raw materials consistently rise above their long-term trend lines.
A decade or more.
It is a massive multi-year trend driven by global industrialization, population growth, or massive structural shifts in supply chains.
And what happens during that cycle?
During an upward supercycle, resource exporters experience incredible sustained economic booms, while importing nations face years of grinding inflation and relentless currency devaluation.
How does a country even begin to build a long-term fiscal strategy when its currency is locked into a regional alignment, deeply vulnerable to a commodity supercycle dictated by the geography next door?
It is arguably one of the hardest challenges in modern macroeconomic governance. You are effectively trying to steer a ship while someone else controls the ocean currents.
Wow.
And this regional alignment, this intense structural dependency on a neighbor's resources, is perhaps most dramatically visible when we look at Europe over the last 50 years.
Let's zoom out for a second and look at the European equation. Because historically, European economies built their incredible industrial might on a foundation of heavy reliance on Russian energy.
They absolutely did. For decades, the economic conditions of the European continent were directly, physically linked to Russian energy supply.
The pipelines were the literal baseload power for European heavy industry.
And because of that deep dependency, any uncertainty regarding supply disruptions historically caused rapid, violent reactions in European currencies.
The sensitivity was just extreme.
Oh, it was. If energy supplies looked uncertain, the foreign exchange markets immediately repriced the euro. Traders understood that a disruption meant instant inflation for European consumers and a massive hit to European industrial output.
Because factories would have to curtail operations.
Exactly. And that destroys a nation's trade balance, which instantly devalues its currency on the global market.
But we are watching a massive historical shift right now. Europe is aggressively diversifying.
Very aggressively.
They are hunting for alternative suppliers, pouring unprecedented capital into renewables, and rapidly building out liquid natural gas infrastructure. They are actively trying to sever that historical pipeline link.
And this diversification will eventually reshape how energy shocks affect European currencies. In the long run, the euro will behave very differently, but the transition period itself is agonizingly complex.
It is the ultimate real-world macroeconomic stress test. Can you rebuild the foundation of an entire continent's energy grid while the factories are still running.
That's the challenge. Decoupling an energy relationship of that magnitude requires a massive, incredibly volatile rewiring of hard infrastructure and deeply entrenched pricing mechanisms.
The friction costs must be astronomical.
They are.
So what does the long-term foreign exchange behavior of the euro look like as it makes this transition? It's moving from being highly sensitive to pipeline politics to being sensitive to entirely new global maritime supply chains.
The euro will gradually decouple from localized regional shocks but become far more exposed to global maritime shocks.
Right.
It will trade less on what happens at a specific land border crossing and much more on what happens in global shipping lanes or insurance premiums for liquid natural gas carriers and alternative energy tech markets.
But while that transition happens,
The structural volatility will remain incredibly high because the institutional market doesn't fully know how to price the risk of a new, unfinished system.
and while the markets are trying to figure out how to price this unfinished system, we have to talk about the people actually moving the capital. We have to talk about the narrative machine.
Yes. This is where human psychology really collides with structural macroeconomics.
Because geopolitical narratives heavily shape investor expectations.
The story that institutional capital believes about the future often amplifies currency movements long before any actual hard economic data is even published by the central banks.
The market moves on the forward-looking narrative, not the lagging spreadsheet.
Always.
Yeah.
Large financial institutions, the massive funds controlling billions of dollars, they monitor these narratives obsessively to find their edge.
They deploy entire teams dedicated to analyzing geopolitical rhetoric, long-term energy policy shifts, and subtle changes in diplomatic tone.
And they use these narratives to position massive amounts of capital ahead of expected structural shifts in global trade.
But these institutions don't just execute a quick overnight trade.
Yeah.
When you look at the data, you see that these moves aren't isolated bets. They are sustained campaigns.
Right.
Break down the psychology of macro trading here. What exactly is a currency campaign?
A currency campaign is how institutional whales operate at the highest levels of global finance. They don't day trade the daily news cycle.
They aren't trading the lightning.
Exactly. If an institutional fund manager believes that a long-term structural shift is happening, say a multi-year disruption in global fertilizer supply chains due to new geopolitical alignments, they slowly, methodically accumulate positions.
They build their bet over 18, 24, or 36 months.
They are slowly loading the boat without tipping it over and alerting the rest of the market.
They accumulate quietly to avoid spiking the price against themselves.
And because they control so much capital, their sustained campaign eventually creates an unstoppable momentum in the FX market.
Their heavy, continuous trading actually reinforces the very structural trend they are betting on.
It operates as a self-fulfilling prophecy.
If enough massive institutions believe a geopolitical narrative will shift a currency over a 3-year horizon, their slow, methodical trading campaigns literally make that shift a reality.
The sheer weight of their capital bends the market to their narrative.
It is the sheer force of institutional belief, backed by near limitless capital.
But it is crucial to understand that these whales are not betting on random geopolitical noise. They are betting on the long-term structural realities we have been unpacking today.
They're betting on the physical rewiring of the world's commodity flows,
Yes.
which paves the way for our ultimate conclusion today. We are looking at tomorrow's financial map, the multipolar FX landscape.
The global financial system is unmistakably fragmenting. The era of a single, unified, frictionless global market anchored by a solitary reserve currency, that is shifting.
Shifting into a complex system of distinct regional economic blocs.
Right. And each of those blocks is rushing to build their own resilient financial infrastructures.
The diversification of currency settlement is going to continue to accelerate. Sovereign nations are realizing that heavy reliance on a single centralized system leaves them incredibly exposed to external financial pressures.
And they are actively reducing that exposure.
But regardless of this financial fragmentation, and regardless of the new regional blocs and alternative currencies being launched, Russia's sheer undeniable commodity power ensures it remains a permanent structural force in international foreign exchange.
It's an inescapable reality.
So what does this all mean? When we look at the grand scheme of this global machine, how should the listener process this shift?
Geopolitics may dictate the temporary rules of the game. Politicians can draft restrictions, they can draw borders, they can mandate tariffs.
But commodities dictate the unbreakable physics of the game.
Exactly. The financial map is absolutely breaking into multiple poles. But the physical resources, the energy, the metals, the grain, they remain the ultimate anchor of reality.
Imagine the foreign exchange landscape 20 years from now. We might not see one single, undisputed, dominant global currency clearing every transaction.
No, we might be looking at a highly complex, interconnected web of regional commodity-backed settlement networks.
The global ocean of centralized liquidity is actively being divided into those regional lakes we discussed.
And the long-term health of those lakes will depend entirely on the physical resources flowing into them and the friction required to move capital between them.
We have covered incredible ground today. We started by moving completely past the illusion of the daily news cycle.
We stopped watching the lightning of episodic events and started tracking the structural ocean currents.
We unpacked how physical energy trade acts as a massive monetary transmission channel, directly dictating local stagflation and central bank interest rate policy.
We explored the complex paradox of financial restrictions, how the very tools used to isolate a financial system inherently act as the catalyst for the creation of parallel alternative global networks.
We analyzed how global liquidity is clustering into a multipolar world, driven by regional FX alignments, commodity supercycles, and massive institutional currency campaigns.
As we look to the future, it is clear that this fragmentation of the global financial system is not a temporary glitch.
No, it is not a bug that will be patched out when geopolitical tensions eventually cool down. This structural fragmentation is the new operating system of the global economy.
Every time you look at global exchange rates from now on, you're not just looking at abstract numbers ticking on a terminal.
You are looking at the digital reflection of wheat, oil, and metal physically moving across the earth. Which leaves us with one final mind-bending question to mull over as you go about your day. In a world where financial networks are increasingly fragmented and trust in traditional fiat currencies is constantly being tested by inflation and structural friction, what happens to the very definition of a reserve currency when the raw, physical resources themselves become the ultimate reserve?
That is the question that will redefine everything we know about global finance.
Thank you for joining us on this deep dive. We hope you walk away with a newly elevated understanding of the magnificent, complex, and structural machine that runs our global economy. Until next time, keep looking beneath the surface.